Hey everyone, in this video I'm going to highlight one dividend stock that's down 49% off its high that I think you might regret not buying on this dip. What is the dividend stock? It's 3M. So in this video I'll show you some of its financial metrics to kind of substantiate why I think this dividend stock is a buy here. Starting with its dividend yield. Of course, one of the more important things dividend income investors look for is the dividend yield, and 3M offers a robust dividend yield of 5.65%, more than you can get for a 10-year government bond, which is offering roughly around 4.2% as of this recording. The other thing I wanted to highlight is 3M's revenue growth over the trailing 12-month period. Now, it is a volatile revenue company. It is, I don't want to say highly cyclical, but it is relatively cyclical. You could see revenue going up and down here over the last decade. But if you draw a trend line here from 2014 to where it's at right now, you can see a nice upward trending revenue growth here. Now, remember, 3M benefits when people buy things instead of services, more so when people buy things. And so 3M benefited strongly during the earlier stages of the pandemic when people were buying more things and were unable to spend so much on services. However, the flip side is now true as people are unleashing pent up demand for things like travel and going out to restaurants. That hasn't been great news for 3M. However, over the next few years, I fully expect, or I can reasonably expect, 3M's revenue to sustain that upward trending revenue line over the next decade. The other thing I wanted to highlight is 3M's strong free cash flow generation. Even though it's taken a major dip here in the most recent year and a half or so, partly for the reasons why I mentioned earlier, you can still see an upward trending line here, even if it's moderate from the last decade, and still 4.44 billion in free cash flow is a solid free cash flow rate when you compare it to its overall revenue, which came in at around 33 billion last year. So the company generates more than 10% of its revenue in free cash flow, which is solid for a company as mature as 3M. And now, I will highlight there are some risks with 3M. It's got some legal issues. It's settling these cases at amounts that were better than initially feared. So far, that's been good news for 3M, although it's not yet complete. So that remains to be seen. However, that being said, the stock price is relatively cheap. 3M is trading at a forward price to earnings of just 10.91, which in my opinion more than incorporates many of the risks associated with the stock. And there are some risks with this stock, right? You've seen the revenue declining, you've seen the free cash flow declining. I mentioned the legal cases. And so all of that has brought down the valuation. But I believe at this value, a lot of that risk is already incorporated. And so you're getting the stock at a reasonable risk versus reward if you're a passive income investor looking for a company that can pay a strong dividend yield over the next decade or more. For that reason, I think 3M is one dividend stock down nearly 50%. You might regret not buying on the dip. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.